Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
Okay, so let's start with the closing data from yesterday. That's Friday, January 30th, 2026. Gold.com, ticker GOLD, it closed the day at $51.85. Now, that was a down move, 3.14% on about 1.13 million shares. But frankly, you can't just look at that one day in isolation. We have to contextualize that little pullback against the massive surge we saw earlier in the week. I'm talking specifically about the January 27th session where the stock jumped nearly 16% to 51.15 on 1.5 million shares. That was the day they rang the opening bell at the NYSE. So the real question we're debating today is this. Is the company that we used to know as A-Mark Precious Metals just riding a temporary, hyper-volatile wave? Or is this rebranding to Gold.com and the move to the NYSE signaled a permanent structural change?
I'm going to argue that Gold.com has successfully turned itself into a vertically integrated capital markets platform that absolutely justifies a premium valuation.
And I'm coming at this from, well, a completely different angle. I'd argue that despite the incredibly flashy rebranding and, yes, acquiring that premium Gold.com domain, the fundamentals here still show a low-margin wholesale business. And right now, it's trading at an unsustainable multiple that's being driven, I think, entirely by speculative mania and a fear trade, not by operational excellence.
I get why you'd take that view if you're only looking at the legacy business model. But let me offer a different perspective on what's actually happening here. We are witnessing a corporate metamorphosis. The transition from A-Mark to Gold.com isn't just cosmetic. It is a strategic alignment with the single strongest asset class of 2026. We are looking at a perfect storm of macro catalysts that this company is just uniquely positioned to capture. I mean, consider the environment. You have gold hitting record highs above $5,500 an ounce. You have the Federal Reserve pausing interest rates. And maybe most significantly, you have President Trump's recent tariff threats, 25% on South Korea, 100% on Canada. This is driving a massive debasement trade, and investors are scrambling for equity exposure. The technicals back this up.
The stock is holding well above its 50-day moving average of 3302 and its 200-day of 2601. That tells me this is a sustained trend, not a fluke. And fundamentally, the acquisition of Monex Deposit Company, that's a game changer. That's $835 million in revenue that they've now integrated, giving them direct access to high net worth clients they just didn't have before.
I'm sorry, I just don't buy that the rebrand changes the fundamental math of the business. Let's look at the numbers, specifically the valuation. We are looking at a trailing PE ratio of over 184. That is astronomical. That is a multiple you usually see on high-growth software companies with, zero marginal costs, not a precious metals dealer that has to move physical inventory. And while you bring up the revenue, which, yes, it surged 35% in Q1 to $3.68 billion, you're ignoring the bottom line. The company posted a net loss of $939,000 for that same quarter. And why? Because operating expenses spiraled up by 122%. To me, the whole Gold.com thing looks like very expensive marketing that's just masking a low-margin, high-volume wholesale model. On top of that, the RSI has been hovering above 70, deep in overbought territory. This stock is priced for perfection in a market that is, historically, extremely cyclical. When the mania fades, that multiple is going to collapse.
I'm not convinced by that, because I think you're comparing Gold.com to, the wrong kind of company. We need to distinguish it from the mining majors. Take Newmont, for instance. Newmont has a massive market cap, around $113 billion. But investing in Newmont carries extraction risk. I mean, mines can collapse, governments can nationalize assets, labor strikes happen. You're betting on geology and politics as much as you are on the metal itself. Gold.com is a pure volume play. It is a much smaller market cap, about $1.3 billion, but it pushes massive throughput. We're talking $11.94 billion in revenue. They don't have to dig it out of the ground, they just have to move it. And as volatility increases, spreads widen and their profitability goes up, regardless of whether the price is going up or down, just as long as people are trading. It's a platform play, not a mining play.
That's a compelling argument on the surface, but have you considered the ceiling on that model? Being a middleman is always capped your upside because you are totally dependent on the spread. If you really look at their peer group, they should be compared to industrial wholesalers like Ryerson or Vestas. Those companies trade at much, much lower multiples because the market understands the margin limitations of a distribution business. I mean, Ryerson moves metal, just like Gold.com, but Ryerson trades at a rational multiple of its earnings. Gold.com is currently being valued like a software company, but at the end of the day, they're shipping heavy metal bars in trucks. There is a physical limit to how fast they can scale that, unlike software. And as for the volume play, let's talk about their moat. You see these relationships as a strength, but I see a massive dependency risk.
The relationships are the moat. You can't just start a company tomorrow and replicate what they've built over 60 years. This isn't just about knowing a guy who sells gold. They have authorized purchaser status with the U.S. Mint, a designation they've held since 1986. That lets them buy gold, silver, and platinum coins directly from the government. Do you know how hard that is to get? It requires massive capital, strict auditing, and decades of trust. They have similar ties to the Royal Mint in the UK and the Royal Canadian Mint. This creates a supply chain that is virtually impossible for a disruptor to break into. And then look at the logistics. They're integrated with UPS, FedEx, and secure transport leaders like Brinks and Loomis. That creates a massive barrier to entry. If you're a high-net-worth individual buying $5 million in gold, you need that security. You aren't buying that from a startup. Gold.com provides that.
Okay, I agree the infrastructure is real. But does it justify a 184 PE? That's the question. And there's a risk in those sovereign relationships you're calling a moat. If the U.S. Mint supply tightens, which happens all the time during high demand, Gold.com's volume immediately suffers. They're beholden to the Mint's production capacity. So if the Mint can't strike coins fast enough to meet the panic buying from those tariff threats you mentioned, Gold.com has nothing to sell. That's not a platform, it's a bottleneck. They don't actually control their own supply chain. If the government shuts down or runs out of metal planchets, Gold.com's revenue just halts. That's a fragility that you're painting as a strength.
And that brings me to the strategic catalysts, because management is aware of that supply constraint, and they're diversifying away from just selling coins. They're making moves to own the customer relationship and increase stickiness. Look at the launch of the co-branded credit card. This is a pivotal move into fintech. It rewards consumers with cashback on JM Bullion purchases and everyday spending. This puts the brand top of wallet. It creates recurring engagement with millions of clients rather than just waiting for them to make a one-off purchase during a crisis. It turns a transactional customer into a relationship customer. So when that person goes to the grocery store, they are thinking about their gold accumulation. That is powerful psychological real estate.
I see the credit card a little differently. Co-branded cards are notoriously hard to make profitable quickly. It's a low-margin, high-competition space. You're up against Chase, Amex, Capital One, banks with unlimited balance sheets. But what's more concerning to me is the international expansion strategy. Look at the Atkinson's bullion coin seal in the UK. Gold.com just increased its stake to 49.5% in January. To me, this just looks like empire building.
I see the Atkinson's deal as brilliant. It gives them a foothold in Europe and a sophisticated online retail platform without the full risk of an acquisition yet, and they have an option to go to 75% by December 2027. That is a brilliant, low-risk way to scale globally. They get to test the waters, integrate the systems, and then pull the trigger on full ownership once the synergies are proven. It's disciplined.
But at what cost? You mentioned the Q1 net loss earlier. That loss was driven by these acquisitions, Monax and the costs tied to Atkinson's. The company is buying revenue, but they aren't necessarily buying profitable growth yet. Operating expenses up 122% is a huge red flag. They are scaling the top line to justify the stock price, but their operational efficiency is actually getting worse. They are bleeding cash to look bigger, and investors are paying for a growth story that is currently losing money. If the price of gold stabilizes, they're stuck with this bloated cost structure and no mania to bail them out.
Growth requires investment.
The loss is an accounting reality of aggressive expansion during a supercycle. You don't build a global platform by saving pennies. But let's talk about who believes in this story. If you look at the market mechanics, specifically institutional ownership, the smart money is overwhelmingly long. We're seeing institutional ownership between 62 and 74%. BlackRock holds 1.37 million shares. Vanguard holds 1.17 million. And we just saw MFS initiate a new stake. These aren't retail day traders. These are the titans of asset management, and they are buying.
That's an interesting point, but I'd frame it differently. When you look deeper into the plumbing of the market, the signal isn't nearly as bullish as those headline numbers suggest. Look at the short interest. It rose to 1.92 million shares in late January. That's 10.42% of the float. That's a significant chunk of the market betting on a correction. But what's even more telling is the dark pool activity.
Dark pools are just how institutions trade large blocks without moving the price. It just validates the institutional interest.
It validates activity, yes, but look at the nature of it. Dark pool activity has been exceptionally high, often 40 to 60% of the daily volume. And specifically, on January 27th, the day of that big surge, off-exchange short volume was 38%. When you combine high dark pool volume with high short volume, it suggests that these institutions you mentioned, BlackRock, Vanguard, might just be hedging their bets. They aren't just buying outright, they're likely using complex strategies to protect themselves. They're participating in the volatility, not necessarily endorsing the $51 valuation. They're renting the stock, not owning the thesis.
I think you're reading too much bearishness into standard hedging mechanics. Every major fund hedges. It doesn't mean they don't believe in the upside.
Well, what about the insiders? You can't hedge insider sentiment. The CEO, Greg Roberts, sold roughly 47,000 shares in December. If the supercycle is just beginning, why is the CEO cashing out?
I was waiting for you to bring that up. Context matters here. Those sales were structured option expirations. It wasn't a lack of faith. It was just executing options that were about to expire. Greg Roberts still holds over 1.25 million shares. He is heavily aligned with shareholders. Selling 47,000 shares out of a 1.25 million position is a rounding error. It's just housekeeping. Now, if he was dumping half his stake, I'd be worried. This is just managing a compensation package.
Perhaps, but it's still paper hitting the bid at a time when you claim the stock is about to go parabolic. It sends a mixed signal, at best.
Speaking of parabolic, let's look at the correlation that really matters right now. It's not the bank analysts, it's the prediction markets. I want to highlight the incredible correlation between GOLD's price action and polymarket.com. This is where the real signal is coming from.
Prediction markets are fascinating, but are they reliable indicators for equity valuation? We're talking about blockchain betting. Are we really valuing a billion-dollar company based on what gamblers think?
In this case, yes. Look at the timeline. On January 26th, Polymarket gave an 81% probability of gold hitting 5,500. The very next day, GOLD stock gapped up. The wisdom of the crowd on Polymarket was pricing in the surge before the equity market fully digested it. While banks were slowly revising their targets, Polymarket traders were betting real money on the breakout. Gold.com has become the equity proxy for that prediction market sentiment. It's the vehicle the market uses to express the view of the crowd.
I'm sorry, but I just don't see that as a bullish signal for the future. I view that as dangerous speculation. If the stock is moving based on gamblers on a blockchain, that just confirms my thesis that this is a mania. Look at the current odds. Polymarket traders are treating $6,000 gold as a coin flip. It's hovering around 50%. That means there's a 50% chance the rally just stalls right here. And if the crowd is wrong and gold drops, that forward-looking scoreboard breaks. And if the metal price stalls, gold stock has a long, long way to fall, from $51 down to that 200-day moving average of 26. That's a 50% drawdown risk based on a coin flip.
But that volatility is exactly why the volume remains high. You're missing the forest for the trees. Even if gold stays at 5,500, the churn and the interest keep Gold.com's revenue engine firing. And if the crowd is right, and remember, they were right about 5,500 and 5,500, then $6,000 gold flows directly to Gold.com's bottom line. The operating leverage is massive.
Only if they can control those spiraling expenses we talked about. You can have all the revenue in the world, but if it costs you $1.05 to make $1, you go broke.
Which they will as the Monex integration finishes. This is a transition period. The costs are front-loaded, the revenue is recurring. You have to look past the Q1 noise.
So let's summarize where we are. Gold.com is undeniably a solid company. I'm not denying that. But the current price around $51 reflects absolute hysteria. We have a PE of 184, recent net losses, and a reliance on a spot price rally that is prone to sharp reversals. The market is pricing this wholesaler like it's a tech monopoly. I'd recommend investors stay very cautious and watch the February 5th earnings call very closely. That is the only thing that matters right now. We need to see if those margins actually improve.
I just see it differently. The rebranding and the vertical integration have fundamentally changed this asset. It is no longer just a wholesaler, it is the primary equity vehicle for the debasement trade in a world of tariffs and failing fiat currencies. The correlation with Polymarket suggests the market anticipates even higher metal prices which will flow directly to earnings. The stock is a lightning rod for geopolitical sentiment.
We can agree on that. It is certainly a lightning rod.
And that's why the February 5th earnings report will be the decisive moment for this valuation. We'll see if the transformation is paying off on the bottom line.
Indeed, it's going to be a volatile week.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.